Good morning. I'm Peter Cowan, Managing Director of Sutton Capital Partners. We're a technology investment bank and work and advise with a lot of early growth companies, a lot in SaaS and fintech. Welcome to the second of our weekly series on the mindset of an investor. Today it's going to be with a focus on SaaS, software as a service. We're very fortunate to have Mark Mullen with us, one of the leading SaaS early stage investors in the country. As a co-founder of Bonfire Ventures, his seed investing experience spans 20 years. His firm's investments include The Trade Desk, OpenPath, Disco, Particle, and Reaction Commerce. He's also on the board of directors of a very large public company, Altus, as well as on the board of a number of early stage companies that they've made invested. And previously Mark founded Double M Ventures and Mull Capital and served as CEO to the City of LA under Mayor Villaraigosa, and before he was a managing director of mergers and acquisitions at Daniels and Associates and then at RBC Capital Markets. I hope again all of you are safe and optimistic that we're going to get through this pandemic sooner than later. And so the purpose of today is to get and understand how Mark is looking at these opportunities. We plan to talk to Mark for about 30 minutes and then have 10 minutes of questions and answers. Please send your questions through the Q&A tab on the toolbar at the bottom of your page, and we'll try to answer as many questions as we can. We're also going to have a chat section open this time so that people can also share thoughts with each other and try that out. As always, we're open to feedback, and we appreciated the feedback from last week. And want to remind you that this will also be online, so you can share this, and we'll review that. So, Mark, welcome and thanks for being with us.
Hi, Peter. Thanks.
So, let's start off with a little bit about you. Tell us a little bit. I've given people an overview that you're clearly an expert on SaaS, and you've made a number of bets, and your fund has done very well in backing early stage SaaS ventures. I personally, I think a lot of people admire your discipline and so far the entrepreneurs you've picked, and you've made bets at a very early stage. Before we get into that though, to understand your mindset, tell us a little bit of something about you that people don't know.
Well, good to be here, Peter. Thank you. And sorry I didn't wear a tie. I had to follow Tim Draper last week. That's a hard guy to follow in every case, but I would have had to go deep into my storage to find a tie. So thanks for having me. I think it's not that exciting, but I've had a really fortunate opportunity to live in quite a few places that are major places in the world. I actually was born in Iowa and grew up in Boulder, Colorado. My father was an entrepreneur in the ski business. And so that was a great way to grow up in the ski business and then in the restaurant business. And my mother was also an entrepreneur in her own way. And so after college, I lived in San Francisco, and then I moved to Paris, France, and started a business there. Then I moved to London, England, and then I moved to New York City, and then I moved to Los Angeles. So I've had quite a wide range of experiences in those countries. When I was an investment banker for over 20 years, I worked for one of the most famous, he's a multi-billionaire, but a famous entrepreneur named Bill Daniels, who was known as the father of cable television. And we did transactions, M&A, private equity investing, acquisitions, investments in more than 30 countries while I was there. And so I ended up working with and for and partnering with and investing in a number of different types of entrepreneurs from many different countries. And so it gave me the kind of confidence, frankly, but also the breadth to encompass and understand a lot of different things that go into making a successful entrepreneur.
Good. Thank you. So that's always a healthy perspective and broad-based, especially today. So, one of the things that you want to understand, the world's obviously changed dramatically. The purpose of this interview in this series is to say, how's it changed for you, both, in your mindset, but also as much with where your time is and how you're spending your day and how you're spending your thoughts. You obviously have a portfolio of companies that you've invested in. So give us a sample. What's a typical day like for you, or in the course of a week, a couple of different days that you do today? Obviously, you're at home, right?
Yeah, so days are a little atypical. Well, first of all, as a reminder, we have a team at Bonfire Ventures. Jim Andelman, my partner, who also has been a longtime investor with Rincon Ventures. We've added 2 people in the last 2 years. Brett Queener, who was one of the original employees at Salesforce and worked there for 11 years and has started companies himself, and also Tyler. And we have Lauren and Craig as well. And so we have quite a good team and quite a broad team experience-wise. And in general, Jim and Brett and Lauren are in Santa Barbara. Craig and I and Tyler are in Los Angeles. That's the way we've already been operating the firm. We, of course, see each other on occasion. We're always on the phone, Zooms, et cetera. We were already doing a Zoom meeting. We've been doing Zoom meetings for a couple of years. And so we have a very good communication platform and how we communicate amongst ourselves already. We were already working, from a mobile situation. And so that's made it very easy for us to continue the communication we've had and how we approach and manage and help our companies. So as a matter of fact, we ended up having a retreat planned in the first week of March that was unrelated, obviously, before COVID had hit. And we just turned it into a COVID day. It was a Zoom meeting. It was 9 hours. We literally went through every single company in the portfolio. We condensed what we already have, which is a report card on every single company that we go through every week, down to a 1-page, very succinct summary of what was happening, where their cash was, what the runway was, how long was their runway, what was COVID going to do to the company, positive or negative, because we have had positive situations, and then what needs to be done from the team immediately. And then we literally had a red, yellow, and green marker. And, thankfully there were a lot more greens than reds, but there were 9 red companies, which meant that they were in danger over the next 6 months of running out of cash. And so you can imagine that those 6 got the first triage of attention, right? It was okay, what can we do? Is there anything we actually can do to help them other than write a check? Or are these companies actually in a certain amount of trouble and they were going to not be successful anyway, and COVID has accelerated that process? And so we've reduced that 9 to 4, just to be honest, which has been a fantastic way. It's been a really methodical way that we worked with every single company. Now, every company is different, right? Just as you had mentioned, I'm on the board of a public company in New York City. It's in 26 states. It has 10,000 employees. We have 10 billion of revenue. When I'm dealing with issues with a company that has employees in 26 different states, that's quite a different problem set than a company that is based in Santa Monica that has 7 employees, right? But there's similarities across all of them. So as a team, we've been extremely efficient and didn't miss a beat in terms of how we work together. And now we go through that report card twice a week. And so really what it entailed was real verbal conversation. It was, let's forget the email for a while. Let's just get on the phone and start talking to everybody. And it just depended really on the entrepreneur herself, right? It's what kind of background did she have? Has she been through these stresses before? In fairness, a 40-year-old entrepreneur had some advantages over a 25-year-old entrepreneur because maybe they've been through the 2009 crisis and seen how we come out, or the 2008 crisis. So we're just trying to adjust and offer different levels of information and experiences, which is quite broad for all Jim, Brett, me, Tyler, et cetera.
So let's jump into this, and I'd like to go a little deeper on this. And so clearly you're experienced and you're coming into early companies. So you're making seed investments. These companies, I know some of them have a sprinkling of revenue, some of them don't. Some of them are 2-3 times successful CEOs that you know and you support. Others are first time with very good backgrounds. Obviously, a lot of them have worked at SaaS companies. You have obviously your group has deep experience with SaaS and notably Salesforce. But what I'm interested in, I think the audience is too, is there are companies that are in the red or the yellow. Obviously, as a venture capitalist, you are making decisions because you want to back the best winners, and your time is one of the most valuable resources.
Yep.
Has this accelerated the bad news or the news where you're saying, we can't support you, we might have been able to a little longer, and how do those conversations go? And then the second question is, how do you communicate with those companies that are in the red, both the ones that won't make it and the ones that seem to have come out of it?
Well, first of all, we're not the type that would say, you're not going to work out. We got to go spend time with these other people. So we'll, of course, people do that. In reality, that's the situation. But so we're never going to be that type of investor. And so we're going to try to be as helpful as possible to the point of them getting through this or failing. The real trick is to try to help them identify what are important costs going forward and what is going to happen to your revenues. And every single investor in the country has been spending time with their portfolio companies reducing burn, right? Because that's the one variable that you have some control on. Right now, you don't have a lot of control on anything else. And so the variable that you might have control on is reducing costs. And that's a really tough thing. It's hard to fire people. It's just a human nature problem. Like it's sad, right? And some are better at it than others. Some look at it as this is a decision that has to be made. And so we've worked a lot with the founders on kind of the mentality of that process and also supporting them in that process and trying to figure out how to minimize costs at this time. The hard part for everybody is now we're getting into this period where revenue is starting to get adjusted. So you think you've extended your runway for sure by reducing your costs, but you also assumed a certain revenue. And now we don't know if that revenue is going to start to fluctuate downward. And then you might have to readjust. So we're just making sure that everybody's aware of these things that can occur and should be happening inside of your company to give yourselves the best chance. If there's a situation, sorry, Peter, if there's a situation where the company really was performing well or fine and in a path to raise money, let's say in September, so let's just do a traditional path where they've raised seed money, they've done a good job, they were planning on going out to raise in September and close in December. Now they need to raise sooner than September just because of what's happened in COVID. Of course, we're still working with them and working like we always do, which is introducing them to investors, working on their deck, focused on that in terms of real fundraising process. But on the companies that are clearly in trouble, it's not like us, we have to tell them that. If you've got 4 months left of runway and we're in this current environment of investment, the situation is kind of dire.
Fair enough. And so I think, by the way, you've done a very good job of getting deeper into, here are companies that have a few months. That's part of any venture capitalist. This is going to be a tough situation for you. And you certainly have deserved a reputation of being supportive of entrepreneurs. Now, as you go and you work with those companies that were red to yellow and the ones that are in yellow, has the runway changed? Mm-hmm. And has the valuation expectations changed? What's going on there?
Right, and just to add a little more detail, green is obvious, right? We kind of set it at 24 months minimum runway.
24 months, thank you. That's
some have more than that. Our portfolio, we have several companies that are doing very well and also have raised a lot of money in the last 3 to 4 months.
Yep.
And while they will be up and down with COVID, they have quite a lot of capital. And in some cases, like OpenPath, pretty experienced entrepreneurs. Like I still talk to those guys every week, but I kind of learn from them, But and then we have the red, which we talked about. So really, the biggest group is kind of the yellow. And the yellow ends up being runway anywhere between 9 and 18 months that may be now compressed slightly. And these are businesses, as I was mentioning earlier, that are actually performing well. They were performing on track, but now we'll have to accelerate their own fundraising process. And so those end up being the companies, naturally, we spend more time with. We're trying to move the yellows to the green and keep them out of the red, just to be pedantic about it. Like, that's what we're trying to do. And so, I don't know if that, that.
No, that answers that. And of course, that's really where we want to dig deeper. So you've talked about a runway. You've talked about, the last 8 weeks, there's been a disruption where, especially because of SaaS companies, a number of them may have paid by the year,
Yeah.
but there's going to be an impact coming. So certain sorts of metrics may be a little more difficult to gauge. You can understand the usage, you can understand your clients' customers and how safe they're going to be. I mean, we've certainly had discussions that if you're in the travel industry, the hospitality, there's a series of other industries that have been hit very hard, and others have been unwitting beneficiaries.
Yeah.
24 months is a good insight, and I think it's great that you're sharing those specifics, that these ones in the yellow have a shorter runway. They're going to need more capital. You're accelerating this. Let's talk about valuations. What happens when, before you were backing great entrepreneurs, it was a competitive environment. You were coming in at valuations that were pre-COVID, or the market was. The world's changing a bit. What are you seeing in valuations in terms specifically for those companies that aren't flourishing?
Yeah, so I mean, it's pretty wide. We have, we just closed a deal today with Brainbase. I'm sure you saw that. Brainbase just raised $8 million from Bessemer. So there are still lots of financings happening, right? I think that the good companies are going to keep winning and going to keep raising money. Valuations, I would say, are at this point kind of an easy, only 10 to 20% discount, to what they may have gotten. I'm kind of of the mindset that is going to get lower. The valuations are going to go down further. Venture has always been either swinging too far either side of the pendulum, and have always been a follower rather than a leader and on valuation. So I think we're going to see valuations come down. But what's happening is that even in our own portfolio, where there's an opportunity to actually raise money. So, you have companies that are going to have trouble raising money, but the companies that can, we have been very supportive of just saying, why don't you just add a couple $1 million into your last round? We're not going to spend the time with lawyers, restructuring, do all this. We like the company, we'll put $1 million in, let's get the other investors in, or maybe we'll help bring some new people in, and let's just open up the last round. And, that's always a dilution question for the founders, but it's not us trying to be, taking advantage of the situation. It's like, let's get more company. If you don't do this, what's it matter? You own 80% of the company or 70 of a zero, doesn't matter. So let's get this done. So I think we're seeing a lot more openness for that, and it comes in the environment. So we've kind of said to people, and as you know, we're part of the Foundry family. We have said to people, like, in this environment, without the opportunity to meet physically new founders, our opportunity set is going to be in putting money into companies where we already may have known the founder and didn't do the round earlier, or we may know the VC that's the lead in it, and we trust those VCs. And so we're having a chance, there's some due diligence and some relationship building that was done without us that we can rely on. And so imagine a situation where a venture capital firm calls me and says, hey, we've got an opportunity where we're going to put another $1 million in. If you guys want to join us, this is how the company's doing. This is great. And it's going to be at the last round. And we may know the founder. We're much more open to that and more excited about that than just starting a brand new thing from scratch. Now, if you call me and say, hey, we're going to put in $2 million, another $2 million, and they give me a valuation that doesn't make sense, or it's an increase from the last valuation, it's like, we don't have time.
So that's fair. And what you're saying is you're seeing 10 to 20% discount, and you're saying it's likely to go lower. And we're seeing some other venture guys that are saying there's already some blood in the waters. Yeah. And I think and so what I'm hearing is you haven't, there's always examples on each side. You have not seen that yet for, obviously some companies won't make it, but you're talking about companies that are solid with good leadership. Yeah. Maybe they've had a hiccup. You're not seeing blood in the waters.
Well, in fairness, where we play, which is in the seed stage,
yes,
our delta from price and valuation is not as high as when you start to get into later rounds. And so, there's going to be blood in the water just from these companies failing, not because, other investors are trying to come in and squash them because they have an opportunity to do that. And I think that's much more prevalent in the later round deals, Bs, Cs, and Ds, than it is in seed right now. And so, I just think in general, seed valuations were obviously the highest they've ever been 6 months ago.
Yes.
And so we'll see. Now, in fairness, again, lucky for us, we focus on SaaS. Like we only do B2B software. And thank goodness for that, because a lot of our customers are getting recurring revenue. I mean, a lot of our portfolio companies get recurring revenue. A lot of them get annual contracts. So we do have a little bit less volatility in revenue.
Yes.
And that's what we've always focused on. So we're going to stay there. But that's, one of our advantages.
All right, so let's talk about it, because your focus has always been on deep niches. You're not going into general SaaS. You're going into people that have expertise in an industry, a segment, and something that is typically focused on some specialty within a specific industry. What industries excite you, and which industries don't?
Well, we have been a little bit careful on being too specific on the actual industries over time, because we feel like software, to use Andreessen's words, is eating the world and has taken over in every single vertical. And so what we think about is we have some horizontal software platforms that provide services to every industry. It doesn't matter, but we have a lot of verticalization. And so, for example, Boulevard, which provides software for salons and appointment-based businesses. We have OpenPath, which is entrance software, right? We have Brainbase, which is managing IP for brands all over the world. So it's really a verticalization of the software, and really going deep and kind of trying to own that vertical.
Yes.
Is kind of where we focus.
So nothing's changed specifically in your philosophy in the short term. Your premise stays the same, and there's obviously differences in different industries. So, I mean, a company like Boulevard, obviously deals with salons, and for the short term, that's been hit hard. Presumably, that will change over time. Things are opening up, and that are there industry dynamics that you think are just going to change on a more semi or permanent basis beyond, let's say, this next 2 to 3 months?
Right. Well, let me add to my last answer and add more to your question. So where I'm not that interested in doing anything is in MarTech social content. We've never really done content, for example. Right now, we are shying away from, and have been for the last couple of years, anything related to job platforms. Not because they're not super useful, like look at ZipRecruiter, for example, but they are so prevalent. You're an investor yourself. The amount of employee job platforms, resume builders, et cetera, that we get is pretty overwhelming. And so we're trying to stay away from that. We also focus on not getting into investments that are relying on other new companies as their customers, right? So the ecosystem relies on itself in many ways. First customers of many startups are other startups. And so we watch that quite a bit. We also try to stay away from companies that are focused on D2C, unless it's really the guts behind it's really the software behind it. And so that's good. Now, on the positive side, we've been very fortunate to have invested in some telemedicine companies, Optimize Health up in Seattle. We are in Chow Now. Many of you know Chow Now. That's a double MN, Bonfire Growth Investment. They have just absolutely grown dramatically here in the last 3 months. So those types of businesses, which were already starting to be utilized more often, telemedicine, et cetera, as we've all been hearing and reading, and have accelerated dramatically. And that's not going to come back. I mean, once you get used to some of those behaviors, you're going to stick with them.
Very, very good point. So, and you brought up one point here I'd like to dig a little deeper into, and that is something where you say your clients, your partner, the companies you invest in, their clients, you'd rather not them be new customers, you'd rather them be more established companies. Is there a certain criteria about revenue per month that each client provides, or the size of their clients that provides a stability or an ability to grow and charge more? You know, some SaaS companies charge $50 a month, some charge $1 million a month.
Yeah.
When you think of companies, do you look and see how much these companies can charge, and do you put a premium on those that can charge more?
Well, we have such a wide range. I mean, I think, you know, we have what we call ACV, right? Annual contract value. And you're right. We have companies that have $1 million contracts, and we have companies that have $50 a month contracts or even less. And they're managed differently. You know, the larger enterprise type opportunities have a sales force that's direct, that has normally has a much longer sales cycle, and a process that's different than the younger or the smaller companies that do smaller ACV. And when that situation, it's much more of an inside sales team and do it yourself. And so we just really spend the time on understanding what the go-to-market is on any of those platforms. How are they really going to market? What is their sales force and function? How are they actually set up to succeed in the industry that they're focused on? So for example, Twilio, you know, is a software platform. It's now a platform, and it started out as free, and it didn't really have revenue. I can't remember the statistic I read. They didn't generate revenue for almost 5 years.
Right.
And now they generate a lot of revenue. So they had a very frictionless way to go and self-serve yourself in terms of using the platform and learning and using it. And then when it's time to pay, you're like, of course I'm going to pay for this. And so if we're going to have companies like that in the smaller cost per month, we need to make sure they have a go-to-market that supports that. If we're going to have big ACV contracts, then we have to have a go-to-market, which is a direct sales team, and have the right process for that as well.
So in that regard, when a team needs to hire their own sales team, do you have your own view on how much the average contract value should be and where that is? Do you find those discussions common? Do companies transition from one to another in a mix? How do you look at that?
Well, it's kind of like how much can a salesperson support, right? It's kind of 4 times their expenses, the total cost of that. And that's kind of one of a measure we have. So, you know, if you have to pay a salesperson $150,000 a year, including commission, and they're selling a product that sells for $39 a month, they got to sell a lot, and that's not going to work. So it's really kind of looking at all the levers and the pieces of what you're selling and how much you can charge for it to figure out what you can pay and what type of sales force you want to hire.
So in your regard, if somebody's making $150,000, you want them to bring in $600,000 a year of new business?
Yes.
So that's actually a helpful thing.
It adjusts for everything, market, you know.
Sure, and stickability and ability to upsell and all that. Sure.
Yeah.
That makes sense. All right, so you've given us a view of how you've looked at your previous companies, how you see the market, your criteria for investing. I think you've given us a good view on some metrics you use to evaluate deals.
Yeah.
So,
you know, we closed a new fund in January, so we're very fortunate that we did that. And so we're obviously looking for investments still. We have made 2 since, I would say, March 1st. One of them we had known the founder since early January, so I look at that, and we had met the founder several times, and so we're kind of lucky that was already underway. And then we just continued on working together in the process, and we finally closed that this week. Another company which we got to know in early March was, to be honest, 100% Zoom. And the reason we felt comfortable with that was naturally we were introduced to it by somebody we know and trust, who has a relationship with that founder. So that's the bridge that helped us get, you know, the beginning of it. And then it's in a business which we all understood, which is nice, but also in particular, Brett, again, you know, my partner from Salesforce, had, he'd had 4,000 people work for him. He's been all over the world with Salesforce and other stuff. He knew this problem set that this company was solving is a real problem. And we were able to go to numerous potential customers and get, commitment, not commitment that they were going to use it, but commitment that it's something that's needed. So in that case, we both knew the industry very well, and we had good references to the founder and felt like we could do that deal, and we let that deal. But those are only 2 deals we've done, and I do think it's going to get harder. We are getting tons of deals. I'm sure everybody is. I've never seen more deal flow coming in cold, frankly, which is fine. It's just really hard to get through it. But in this environment, I got to tell you, like, we invest in seed, which means we invest in the founders. There's no other way to cut it. And it's just getting harder to have a conversation like this over and over and over and try to decide that's the person you want to invest in. That's just going to be the reality of the situation.
So that's a pretty tough situation. If you're getting more deals than ever, a lot of them are coming in cold. I would think with all that, an introduction from a credible source would be probably more important than ever now, especially if you're going to have to invest in a person who you're actually not going to meet and only through Zoom.
Yeah. Yeah.
That's the,
we've gone back as well to our own database and looked at companies, looking for companies that we met before and maybe liked and didn't get there for whatever reason. Maybe they didn't have enough traction. Maybe the price was wrong for whatever reason, but we liked them, and we're going to reach out to some of those people. Say, hey, how's it going? We're open for business.
Good. Okay, good. Well, we've got a bunch of questions from the audience, and some of them tie in here with what we're doing. So tell us tell us about new opportunities. How many new Zoom meetings or whatever are you doing a week, a month, and how's that different than what you used to do?
Well, we have a couple processes, right? Which is, as a firm, a deal may come in, and we have pretty broad networks, both from each individual, right? Different relationships and backgrounds and LinkedIn communications, et cetera. So we have a pretty broad network, and it's great because we don't really cross over a lot. So there's a lot of opportunity there. And so what happens is a deal comes in to me. I'm the first point of contact for that deal, whether I understand it or not, or whether it's my own sweet spot. And I would make a decision to have a call or a meeting with that person, normally a meeting, particularly if it's based in Southern California. And based on that meeting, I would come back to the team and say, hey, I met with Bonfire Software, and I think that Sally is somebody you guys should talk to. And here's the deck. And then one of the other three decides that they want to have that conversation. And then they go have that conversation, and then we coalesce. And we talk, as I said, we have 2 meetings a week, Monday and Friday or Thursday. And then we kind of progress that. We have stages in our database: initial call, very simple stuff, initial team digging in, et cetera, due diligence. And we kind of run a company through that. And so we're seeing fewer of those situations that get to the next level, meaning the inbound comes in, we still take those calls now. They're just a Zoom instead of a meeting, or a phone call instead of a meeting. And we're seeing fewer of those get to the next stage, which means me saying, I don't think it was the deal that was right for us. So that's kind of what we're seeing. I don't know if I can add to that.
I think that's good. So we're getting several questions that around the theme that you invest in SaaS, average contract value, going forward. A number of these companies are saying we have other sources of revenue besides SaaS, marketplace, certain kinds of other types of licensing, other sorts of revenue to augment, complement SaaS. How do you look at that?
Yeah, so that's a great question. I didn't mean to say we're just SaaS only, because we're B2B software, and software comes in many different forms. It's either transactional or it's SaaS. And in general, I would imagine probably 2/3 of our portfolio is more SaaS related than transactional. But yes, marketplaces, I mean, if you take, for example, Boulevard, who I mentioned, they have a monthly SaaS fee, And then they also charge, they take a transactional fee for all the e-commerce they generate. So we have different revenue streams for some companies. And so we're not opposed to it. We have a company called Branch in Minneapolis. It's not SaaS. It's based on fees they generate from all their transactions. So just to clarify, yeah, it's not SaaS only, but it is B2B.
And are you seeing any changes in the last couple of months of people using different models and or trying to get perhaps a little bit more money up front? SaaS companies are obviously capital intensive to get going. What are your thoughts?
Yeah, I think what we've advised is to some of our companies where it makes sense. If you have 3 to 5, these younger companies don't have hundreds of customers, right? They may have 10, they may have 10 to 40. We're advising them to make sure they are in direct contact with their largest customers, and make sure that if they are coming up for a renewal at any time soon, let's call it 1 to 6 months, that they are in direct contact with them and literally, discussing how to maintain them as a customer at perhaps a discount. We want to make sure that they stay on as a customer rather than coming up and saying, this is just one of those things we can do without, where we don't want to pay $5,000 a month for it anymore. And we're coming in and saying, well, how about paying $3,200? And we'll talk about the next round. You just have to keep the revenue going rather than lose the entire customer.
So, all right. So what do you see here? When do you see a normal or a new normal coming? 3 months, 6 months, a year? Things aren't changing. Just how are you looking at this stay-at-home sort of thing? And what's your view both for your potential partners that you invest in and for your own routine?
Yeah, I mean, it's a very hard thing to figure out. I mean, for good and for bad, like I've been through the '87 crash, the 00.com. I lived in New York City when 9/11 occurred. Went through the 07, 08 crash, of course. And so what that gives me is comfort and confidence in human nature to come back in a form that is better, hopefully, and that we will recover. But in this case, I still believe that, of course, but in this case, considering what's happened, it's nothing like this. I mean, you can't just say, hey, I was in the 08 crisis, so this one's just like that. It's not. It's not at all. Yeah, it was a crisis, but it wasn't a comparable crisis where the entire world was in the same situation, where we have a significant, devastation of hourly workers, hourly wage earners. The economy, as we know, is obviously devastated, and we don't know what it means to add $6 trillion of debt back into the government. Take away that $6 trillion right now. What do you think the stock market's at? Not at where it's today.
Right.
So I'm concerned that we have created a false sense of protection in the market, and we really need to focus on how to take care of the average worker in the United States, and move away from thinking about what the market thinks. And so I have a lot of confidence in human nature being able to take care of some of the issues we're going through. I just think it's going to take a lot of time. And getting back to normal, I think what the reality is, we all went into crisis mode in our own ways, whether it's your own family or getting your family home or seeing where everybody is, then figuring out how to get groceries, then figuring out how to deal with your employees, then figuring out how to deal with your companies, your investments, everything. That was crisis mode for a while. Then we got into the stage now where we're settling into that stage. It's a little less crisis mode, more is this the common operating? Now we're going to have to go into this third stage, and we're starting to see a lot of opening up in the United States, particularly of how do we work? What habits are we going to keep? What habits are we going to keep that actually have been better than what we were doing before? And how does that affect the environment that we're in, which is early stage investing?
Very good. All right, there's a series of questions I'm going to ask you about different markets and your view on them, because people have asked about their specifics. So 3 different markets. One is legal, one is government, and one is auto dealers. Any thoughts on any of them? Anything that good, bad, or you're open to all? What do you think any of them are going to change?
What do you think the legal question means?
I think it's smaller law firms looking for CRM.
Oh, well, to be honest, we've looked at legal technology platforms, and we have not been able to pull the trigger on them. Maybe rightly or wrongly, because we have like 6 law firms that are LPs in our fund. We have a lot of great relationships with a lot of great lawyers, and they're the first people we go to and say, "Would you use this platform?"
Right.
And we quickly, almost always, run into an old school mentality in law firms about using technology, even though they're technology lawyers. And so that's been always the stopping mechanism for us for getting into some legal software opportunities, but they shouldn't be that way. I mean, it's a massive industry that is still old school and is one of those industries that needs to be taken over by software to make it more efficient. If, once everybody realizes that software actually, you don't have to generate revenue from software, but you can generate a lot of efficiencies, which lowers your costs. And so you got to do one of the two. And that's where we think we have to, law firms have to start to, or are starting to open up. I mean, even today, we get invoices from law firms that are exactly the same. I could show you law firm invoices from 20 years ago. It's a piece of paper. It says the lawyer did this, this is how many point hours they worked on. It's just not a long-term, not long-term the right way to go. Government, we have also been naturally, I worked for 1.5 years for the city of LA, came out of it very demoralized about what and how processes get done in the government. We've always been very wary of and have never done a deal where we relied on the government as a customer. However, if you can get the government as a customer, that's a pretty good deal, but it just takes an enormous amount of time and is too variable for us to have gotten into. But it's clearly a huge industry that also needs to be taken over by software. And then the auto business.
Auto dealers.
TrueCar was there have been platforms that have made some inroads into the car buying business, whether it's Fair or TrueCar or what have you, or Shift. I don't have a long-term view on the car. I hope the car goes away in general. But I mean, the funny thing in LA, if you live in LA, we spend our whole time trying not to get in your car to go anywhere. And since COVID started, getting in your car and driving around is actually the only thing you can do for fun. Like I get in the car with my kids and we put the dog in and we just kind of drive around the neighborhood. And that's what we do for fun now. I don't have a position on cars because it's a consumer facing opportunity and we don't really get into that.
Mark, thanks. We went a little bit over because I think there were a series of questions I wanted to get your thoughts on. We really appreciate your time, your insights, and so we appreciate that. For everybody here, there's going to be a recording of this, so if anybody wants to see it again or pass it on to people, this is very helpful. I think Mark is a seed investor, in the first institution. You guys often invest, what, about $500,000 to $1.5 million? What's your typical investment size?
Our first check size is between 1.5 and 2.
1.5 and 2. Very good.
Yeah.
1.5 and 2. Okay. Well, very good. So please join us next Wednesday, 10 a.m. Pacific time, with Arlen Hamilton. She's with Backstage Capital. She'll be a very engaging discussion. She is trying to shake up the industry, look at a bunch of other different sorts of opportunities that venture capitalists haven't looked at from a different perspective. And we want to share with you that we're going to continue this series. We think there's a lot of good insights that are going to come from the people we have here, and we continue to welcome all feedback. We want to thank SaaS Brief for what they do, and they have a newsletter that has some of the thought leaders on that we work with them. If to get some of the articles about what goes on in SaaS. Mark, thank you again, and we appreciate your time.
Thanks. Thank you very much, Peter. Take care.
Bye-bye.